when you take a look at how the market is currently set up, it is potentially in the process of building a fairly significant market low. And again, it's very possible that we could get a retest of the recent lows, or maybe set a higher low, which would be very bullish. But that would be a normal corrective process. And then what will happen is that things that have done very well recently will become a source of liquidity to buy equities.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of another week for another weekly market recap with my good friend, the Nadiral portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing good today. How are you?
Good, good. I hope I pronounced that correctly. That's the adjective form of nadir, which means the low, right? So the big question I have for you today, Lance, is has the market found a bottom? I should note too that as we're talking, Lance, I'm releasing on the channel, because we're recording this on Friday, I'm releasing on the channel a special Friday release with the great investor Felix Zulauf. He only does media once a year. His last media tour was back in December, but he decided, because of so much had happened since he last came on, that actually he had fairly accurately predicted, kind of eerily accurately predicted, that it was time to come and give folks an update, especially given all the market volatility. And one of his big messages is that he thinks we're seeing a classic bottoming process in the markets. Now, he thinks the markets potentially could fall from here and retest the lows, but he doesn't expect us to really go below them. And we can get into this later if you want, he actually thinks while this year will probably be a bumpy ride, as you've said, by fall, he's basically saying, just keep your dry powder till fall. By fall, you really want to start going pretty long, because he expects kind of a blockbuster 26 and 27, which surprised me in that level of optimism. So anyways, question for you, my friend, and we can start however you like. We can pull up the technicals and the S&P or whatever.
Well, but can we start there real quick, just before we get into that? Sure. Because it's interesting, because so I haven't released it yet, but so we're recording this on Friday. I've already written a newsletter for this weekend because the markets are closed for Good Friday. By the way, just to wish everybody a very happy and blessed Easter. I hope you enjoy your holiday with your family.
And Passover too, for those that are having Passover.
That's correct. And so many blessings to you. But it's interesting because this whole weekend's newsletter, and by the way, I have not seen the interview with Felix Zulauf yet, because I was writing a newsletter on Wednesday and Thursday. Yeah. But it's exactly the same message, that when you take a look at how the market is currently set up, it is potentially in the process of building a fairly significant market low. And again, to his point, and we even state this newsletter, it's very possible that we could get a retest of the recent lows, or maybe set a higher low, which would be very bullish. But that would be a normal corrective process. And then what will happen is that investors will want to be very cautious about where they've got assets allocated, because things that have done very well recently will become a source of liquidity to buy equities. So you will expect to see a fairly significant rotation within asset classes. So emerging markets and international things that have done well this year relative to the S&P will become a source of liquidity to fund S&P purchases.
Okay. All right. Well, Lance, let's wait until you see the interview with Felix, and then we can go through kind of where he thinks money is going to go into in this next big upcycle.
Yep.
But it doesn't surprise me at all that you'd written an article on this. I don't think I've come up with a topic yet that you haven't.
Well, no, it's just interesting that basically he came to the same conclusions because our whole work in this weekend's newsletter is just looking at charts, right? Just looking at sentiment and positioning and all these things, which are at levels that have historically always marked near market lows. And so just, from a purely technical perspective, that was where this whole article came from this weekend. And it's discussing the art of contrarianism, right? Which is the hardest time to buy things is when nobody wants them. The hardest time to sell things is when everybody's buying something. And so this is where it becomes very difficult for investors to let go of a particular thesis. This is going up because of, de-dollarization or whatever it is. Very hard to let go of that thesis and just realize that when things turn, then the new thesis will be something else. And then of course, you've got to make that migration or that rotation within the markets. And that's what we're seeing. We're seeing certain asset classes and international emerging markets that are doing well based on a thesis that will revert, and then that thesis will change to a new thesis, and then everybody will forget about the old thesis. And the new thesis is well, it's AI, and it's back to whatever it's going to be in the next leg higher. So this is the challenge of being a contrarian investor, is that you've got to do the very things that are the toughest to do because nobody else is doing them.
So that does echo a fair amount of what Felix said as well. And like I said, he says it's still probably going to be fairly choppy, through fall. And he says, look, what you should do is you should, as things drop and headlines are screaming the world is ending and everybody is freaking out, start kind of nibbling in, again, keep most of your powder dry, but take advantage of those drawdowns if indeed they happen. Until the fall, I don't see him being. The kind of message I took was, hey, if we have some rallies, don't go all
Sell
in.
those.
Yeah, sell those. But as things begin to firm up by the fall, and for him, kind of firming up is he thinks we could go into a recession this year. Not 100%. I don't get the sense from him he thinks it's going to be a crippling one. And again, he sort of said by the fall, that's when there should be really good values, and that's when you really want to start getting aggressive in deploying your dry powder. Obviously, folks, he could come back on in the summer and make a totally different audible call if something else, changes his mind, but that's what he's saying right now. But his point is just like, you're going to have to go against your emotions, right? Yeah.
And then again, that's we lay out all the rules in this weekend's newsletter, which will be on Substack at Lance Roberts. It'll be on our website, realinvestmentadvice.com. I think you post a copy of the newsletter as well through your Substack channel, so it'll be out there. But we actually list all the rules to go through right now about looking at your portfolio, what to look at, what to start positioning for. And he's right, and we said this earlier this year on January the 5th. We wrote that article, curb your enthusiasm, because we just come off 20% back-to-back years. Everybody's all excited about 25. We're still going through earnings revisions. Negative earnings revisions are picking up steam now. So we had talked multiple times about earnings estimates need to come down a lot.
Yeah.
His point about better valuations, later this year and later this summer or early fall is right. That doesn't mean though, don't take lower valuations to mean substantially lower stock prices. Those two are not technically correlated to each other in this type of environment. We could see a retest of the recent lows, maybe even possibly set some new lows, but it most likely is not going to be another 15% downside. So, again, probably most likely a retest of lows. Markets are fairly washed out here. We've got a lot of offsides positioning. And as earnings start to stabilize, and again, we've got a lot of flux with earnings right now. And this is part of the problem that's dragging on the markets, is this uncertainty over tariffs. We had these onerous tariffs. Now they're paused for 90 days. And over the next 90 days, we're going to have all these negotiations with countries, Japan, Vietnam, Taiwan, whoever. China's got a lot of back channel negotiations going on right now. So in 90 days, we may have no tariffs. We may have some tariffs. We may have very low tariffs. So all this concern over tariffs is likely going to evaporate. But the problem is, until there's some certainty, we can't figure out what forward earnings are going to look like. But once the market can get, and this is the thing that's going on, the most important thing for investors to take away right now is, when you look at all these super negative headlines out there, just realize the market is already pricing all this stuff in. So if you're thinking I talked to a guy yesterday. He's like, oh, it's decollateralization, and it's kind of all these. I said, yeah, I get that. It's perfectly fine, but the market's already pricing that in, right? So what you've got to make sure and do is understand that the market at some point is going to come to the basis where it says, okay, that risk is now priced in the markets. I can start buying equities again, and monies will flow back into risk assets.
Yeah. And one thing that, so if you remember, for those that remember, Felix's appearance back in December. He basically said, look, there's going to be uncertainty that's going to create volatility in the markets. Okay, we got that. So that volatility could definitely, could potentially lead to a market correction of 15 to 20% early in 2025. Okay, check, we got that. He then said the new administration's tariff policies, could lead to, some pretty disruptive, trade relations between countries. Check, we got that. So everything that he predicted has sort of happened. And then he said, at some point, the central planners will step in, and they'll kind of, put a bottom on things, right? And I asked him, oh, well, so if you're expecting a recession, do you expect them to step in then? And he basically said, no, I think it's kind of going on now. I think what he meant by that is, I mean, if you look at other countries, right? You look at Europe, you look at China, right? They're already stimulating. Like they're back to, pretty aggressive fiscal stimulus.
The European Central Bank has cut interest rates 7 times with unanimous consent.
Right. So everybody is playing the playbook that we did here in the States to juice our markets. And while this in the US we aren't so much right now, and this is another thing I want to talk to you about.
And hence the beef between President Trump and Jerome Powell this week.
Well, exactly. And really, I mean, what do you think the odds are that the Fed, reverts to cutting this year? It seems
100%.
pretty, okay. Yeah. It seems pretty challenging to think that the Fed won't at some point, especially if inflation isn't running away, which it doesn't seem to be right now. And if the economy continues to slow, as you and I have been talking about a lot. There seem to be more and more reasons that suggest, hey, it's okay for the Fed to start cutting. And as Trump is saying, agree with him or not, he's saying, look, Fed, you're going to be behind the curve again. Like this is exactly when you should be easing here. And I think
I think it's a great point because, the Fed has been making mistakes ever since last year. And again, they've made crucial mistakes really ever since 2020. And when 2020 happened and we shut down the economy and then sent $5,000 checks to households, you should have realized then that imbalance of supply and demand would create inflation. They should not have come in with 0 interest rates at that point and $120 billion a month in QE to juice the markets, because you were just going to exacerbate the inflationary pressures in the economy. But they made that mistake. Then they tried to reverse that process, but they were way too late. You and I were talking about this in 2021. The market's running off to the moon. We're having this massive up here in the markets, tons of speculation. We're doing IPOs and SPACs, and everybody's chasing meme stocks and everything else. And you and I discussed back then, the Fed should have been cutting rates. Should have been hiking rates into that environment and cutting QE while you had all that monetary liquidity from the government circling around the environment. That would have helped stabilize inflation, would have helped cool the financial markets a bit. But no, they didn't do that. They kept the foot on the pedal that entire time. And then when you finally get the Ukraine-Russia war breakout, then they decide that, okay, now's a good time while we have international turmoil. Let's hike rates into that. So you cause a 20% bear market decline. So it's just been one constant mistake after another. Then last year, they cut rates by 50 basis points in September when it should have been at best a 25 basis point cut, if anything at that point, because inflation was coming down, but was still fairly elevated. So the need for a rate cut then was nothing more than really, if you look at it, couldn't have been anything more than just a political move to help potentially support markets going into the election. But again, it's up for debate on why they did it, but it was a mistake. Now they've got themselves into this trap of, well, inflation's still higher than our target. So if I cut rate, I might increase inflation, which isn't going to be the case, because when they've cut rates previously, it's always led to disinflation in the economy, but that's a whole nother argument. So it's just been one constant mistake where they're behind the curve and constantly playing catch up. And President Trump is right, is that he's going to be late this time. The rest of the world is cutting rates. The ECB, like I said, has cut 7 times already. The world economic growth is slowing down rapidly. This isn't a minor slowdown, it's a rapid slowdown. That's going to circle feed back into the U.S. economy. We're already seeing, we wrote last week, about the consumers tapping out, and we're already seeing clear evidence of that. So and now you've got this disruption in the bond market because of deleveraging. So you've got all these catalysts that are piling up, and the Fed should be stepping in here trying to ease that volatility risk to the markets, because if the recent decline in the wealth effect shows up in the economy in the next month or so, they're going to be put in a real bad bind about trying to cut rates and get back ahead of the curve.
Okay. We're going to talk a little bit about some additional signs of weakness in the very important affluent consumer segment that's been supporting retail sales. Before we get there, so last week, you and I talked about how you and several other folks that I've interviewed recently on the channel have said, this year is going to probably feel a lot like 2022, where for the most part, it's going to be this sort of slow, disappointing grind, probably downwards grind. And I think Felix maybe even kind of emphasized that on steroids. He didn't use those words, but basically saying, look, it's going to be choppy until the fall, and we could maybe even retest the lows, right? So that could be the unhappy, frustrating, just grind down in markets for the next 6 months or so. But then, just as we bounced in October of 2022, that's when we hit true bottom, and then the markets took off, and we had 2 great years in the markets ahead of us. That's kind of what I think Felix is predicting here, right? As things start taking off in the fall, and then, hey, get ready for really good returns, or at least strong returns in 26, 27. So yeah, I mean, maybe that 2022 analogy is a good default until we see something that suggests differently.
So we wrote an article on Monday talking about yield spreads and the fact that we're starting to see credit spreads increase between high yield and treasuries. And, it's exactly what you should expect when the market's selling off. You got a lot of bond market volatility like we've had as of late. That increase in credit spreads is, not unsurprising. It's not at levels that are alarming by any stretch of imagination, but they are rising. So we wanted to do an update in that article, which we did. And in the the last part of that article, we go through the fact that we've now triggered our weekly sell signal, which you and I talked about last week. And that was why, we were waiting for a rally in the markets. We had laid out this premise Monday before last that markets were deeply oversold, sitting on the bullish trend support. We would get a fairly significant rally. And into that rally, we want to reduce equity risk by 1/4 to 1/2%, 1/4 to 1/2 in each position. Want to raise cash levels, potentially add a hedge. So we were waiting for that, kind of that announcement Wednesday morning of that week, when before President Trump announced the pause on tariffs, we had bought some technology stocks, NVIDIA, Microsoft, Apple, Google, reduced some weightings in the other area of the portfolio, waited for that bounce. And so when we got that bounce Wednesday afternoon, that 9% rally, we stepped in and sold, reduced positions across the board, raised about 15% in cash, added a short position of the portfolio. And the reason for doing all that is because the setup is very similar right now to what we saw in 2022. So this is a chart of 2022. And then where this crossover is, that's where the weekly sell signal occurred. That's what just happened in the markets. After you got that weekly sell signal, that was when the market rallied, which we just had. That's where we reduced exposure into that rally. Now we're kind of declining here. Now, I don't necessarily expect you're going to have this big secondary decline, but probably a decline, as Felix was talking about, somewhere, retest these lows, could even set some minor new lows. But the difference, and the reason it's different here at this structure of 2022, is that when you take a look at consumer investor sentiment, investor positioning, investors were still very optimistic at this initial bottom. In October of 2022 was where they were super negative, pessimistic. And that was where back then you and I were talking about why we would get a bull market, why we're increasing exposure because of that super negative sentiment. Well, we've got that same level. In fact, if you take a look at the kind of our technical indicators, take a look at our sentiment indicators, they're as negative now as they were during the financial crisis. They are in some cases even more negative than they were at the bottom of the market in 2022. So Felix is right, is that we've already gotten so much negative sentiment and positioning out of the way that there's not a lot of downside left to this market, but a retest of these lows, or maybe even setting slightly new lows. Friday things could happen. We kind of chop around for the next several months. We're going to start to see a development of more positive price action. We'll start to see a positive divergence in relative strength, even though the market's still under pressure. You'll start to see relative strength improving. You'll start to see momentum improving. And that's going to be your signal to start adding into exposure. Even though the market's still under a lot of pressure and things look very negative, that'll be your time to start buying in more heavily into your whatever positions you want to own. And we'll start to see rotations within markets as a whole back into the US dollar in particular to take advantage of those equity prices once they bottom begin to turn up. And so he's right, by the end of this year, I think very likely we get around October, you're going to start to see that bottoming process, start to see all those things kind of align for a fairly strong rally in the year end.
Okay. So, kind of the punchline here for the regular investor is if Felix is correct, and Lance, I think you think he's more likely to be correct than not, it's, kind of hunker down a little bit, in the near term. Again, nibble in on the dips, sell the rips. But basically, as Felix would say, prioritize keeping your capital dry. And then once that stuff gets washed out, then be positioned to start, be positioned for better days ahead, right? Yeah. Okay. Well, folks, we will obviously be tracking this every week here with Lance. So we're providing lots of updates on this. And again, that's Felix's best view of the future right now. There's stuff that could happen between now and then. And if it does, Felix has told me he'll come back on and let us know. All right. So let's see here. Where to go next? Let's see here. Well, you mentioned credit spreads, Lance, and you told us why you're watching them, but you're not unduly concerned by them right now. What is the latest on just the general health of the bond market? We had yields come down substantially, then they went up really quickly. Everybody was worried that there was maybe a brewing crisis in the credit markets. Should we, is there still reason to have some concern? Is it getting resolved? What's the latest?
Well, it looked so, yeah, so yields were doing what they should have been doing. We got down to below 4% on, falling inflation, slowing economic growth. So yields were tracking economic growth and inflation, doing exactly what they were supposed to do. And then all of a sudden, just you wake up one morning and it's like, bam, we're up to 4.5%. That's not economic concerns. That's not inflation concerns. That's a liquidity crisis occurring somewhere within the bond markets that we've talked about before. Credit-related events, right? Yeah, credit-related events are very serious because they impact the financial markets. And we did see a casualty from it. There was a hedge fund that blew up over that. But it seems to be fairly contained. Now, I'm sure there's been a lot of action behind the scenes that we know nothing about between the Fed, Treasury, and the bond markets, and JP Morgan and everybody else. But it seems to be that whatever storm there was that was brewing is getting resolved. We're starting to see yields kind of calm down here a little bit. Volatility starting to drop back down as well in the bond market. So, probably it's not resolved yet. It'll probably take another month or so. I wouldn't be surprised to see some kind of news headline in a couple of months. It's like, oh yeah, there was this little problem that we got resolved, but you didn't know anything about it.
Citadel almost died, but hey, we've kept them alive. Yeah.
But yeah, we'll probably find out. It'll be like the JFK files. We'll find out in 10 years, who it was. But what'll happen here in the next, kind of few months, I suspect, is that yields will start to focus back on economic data. Yields will come down and start to factor in economic growth and, where inflation's currently running. So we'll head back towards that, kind of high 3s to maybe low 4s, and not too distant future, things will calm down here a bit. But if you start getting more recessionary concerns, which is a lot of the headline news right now, of course, you see a lot of headlines like recession risk now 40, 50%. Kind of bothers me that so many people are talking about a recession because generally that means you're not going to get one.
Right.
But if you start getting recessionary concerns, you're going to see yields come down quite a bit more. So, we've got a few things that are going on. We've got a weaker dollar right now. That'll resolve itself here soon. I mean, dollars trade relative to foreign currencies. It's always about balancing currency risk. We've got a lot of stuff going on right now between countries over tariffs and those type of things. That's all going to get resolved. And the dollar is the reserve currency. It's going to stay that way. So when assets start to flow back into the US dollar, it'll have three choices. It can buy gold, it can buy stocks, it can buy bonds. And when you start looking at relative spreads between the Eurozone bonds example and the US Treasury, that US Treasury yield is going to start looking very attractive. And if you're not having currency depreciation in the short term, remember, if I own, and this is really kind of key to a lot of things, is if I'm a foreign country, I transact 70% of all my business in US dollars. Therefore, I have to keep reserve currency in place. But if the currency that I'm storing in is declining, then I'm taking a hit on my reserve currency, because just on a relative basis between the US dollar versus the euro, as an example. So if the dollar's declining, then I've got to make a decision, because that decline in the dollar is impacting me economically. So if I'm also then, which I don't mind just a decline in the US dollar, that's fine, as long as asset prices are going up. So if I'm invested in stocks or bonds and bond prices are rising or stock prices are rising, I'm not as concerned about the currency risk, but it does impair my returns, but I'm not as concerned. But if I'm losing money on this, if my investments are in stocks or in bonds and I'm losing money there at the same time the dollar is depreciating, I've got to pull that money back out. So that's why we're seeing a reversal of money flows. I don't mind storing in gold right now because it's appreciating in price. So I'm not being impacted as much by that dollar depreciation. So that's why you're seeing a lot of central banks storing gold at the moment to balance those currency reserves. But they have to store the reserve. They just got to figure out where to do it. So when there's a depreciation in the dollar, at the same time asset prices are declining, you see this extraction of capital because they're pulling the reserves back to strengthen their currency relative to the US dollar to keep that balance and somewhat in place. That'll reverse. When the dollar starts to strengthen, those money flows come right back in for the same reasons. So we've got to get through this period. And once we get through this period and things start to stabilize and we have more clarity over tariffs and political uncertainty calms down a bit, then we'll start to see a reversion in yields as things start to stabilize, money comes back into treasuries, et cetera.
Okay. And just to give a sneak peek into what Felix thought, he's not a big fan of bonds in the long term, but he says he thinks they'll do okay in the short term, especially if there's a recession in the second half of this year. But it's basically for all the reasons you just mentioned.
Absolutely.
He also has some thoughts about where gold is going, and I'll be a little cryptic just so folks feel extra incentive to go watch that interview with Felix, because it's a must watch, folks. All right. So one of the factors here that has been increasing uncertainty, which has been weighing on both stocks and bonds, has been the whole tariff tempest, right? And I'm going to ask you to put on your geopolitical hat with me for a minute here. And we are not geopolitical experts, so we are just two guys shooting the breeze on this. But Lance, what do you think here right now? What is your gut telling you? Is Trump's aggressive stance? I went on a fairly long I don't want to call it a diatribe, but I think it was 2 weeks ago where I sort of walked through what I believe to be Trump's strategy here, like it or hate it, why I thought he was doing why I thought he was doing what he was doing, and I made the analogy, which I still feel like is a pretty good one, that he basically called everybody at the poker table. And he did it because he believed he's got the best hand, right?
Yep.
And he's essentially trying to push everybody with a weaker hand to cut a deal with us, right? To renegotiate a deal, one, to make it more favorable for America so that, we're not getting screwed by everybody the way that Trump says. But I think more to really, secure more valuable trade relations with countries, right? And there's three things about that. One is to try to balance things out to make them a little more fair, right? Don't tariff our stuff as much as you do, and well, we're not tariffing you that much, right? So we'll get more balance there. Two is to try to strike deals for strategic resources, right? Like, okay, Vietnam, look, we'll get the whole tariff stuff like figured out, and if you've got any major non-tariff, trade barriers, we want to, get those right sized or whatever. But part of this deal is going to be like, yeah, we'll remove this penalty on you, but you're going to buy your gas from us, right? We've got plentiful, cheap natural gas. We want you to commit to multi-decade, deal with us, right? So securing these really strategic relationships. Right. And then the third is, hey, to get all these carrots that we're offered, for us to remove the stick and to give you these really tasty carrots, you got to be on our side versus China. Right. So I think he's trying to get the world to ring fence China in here. So my question for you is, as the dust is slowly starting to settle, I mean, we're still very early on in this process. The critics would say, hey, Adam, I disagree with you. This is just Trump being chaotic, but also, we're burning bridges with key allies and we're, driving people towards China and stuff like that. What does your gut tell you? Is Trump's strategy here, is it starting to pay off? We're hearing about all these, the phone lines blowing up, and we're seeing Japan and India and all these other, key countries come here to strike deals. Or is he risking everything? Has he really damaged the system, and is he putting America, back on its hind foot here? Does your gut tell you we're heading more towards one or the other at this point?
Yeah, well, no. So first of all, I was never a big proponent belief that he was going to just, impose these massive tariffs, and that's where it's going to stay. I mean, you and I were saying very early on when he started talking about this is all stick and carrot. This is just part of the negotiation process, is the way he operates. And, and this is also why the Fed is making a mistake, because, Powell in his statement said, I think these tariffs are going to cause all this inflation temporarily, but there's probably not going to be any tariffs to any great degree. Again, these tariffs were all to the stick and the carrot. And to your point, he's already cutting trade deals where it'll be, hey, Vietnam, you take off all your tariffs on us so we can sell we can sell Ford F-150s to you. And it's a fair trade deal, and we'll buy, all the stuff that we buy from you, and there's just no tariffs either way. And that's where we're going to eventually wind up with a lot of these countries. With China, it'll probably wind up being either no tariffs or some small tariff, whatever it is, relative to what we do for them. Because again, you can't discount the fact that, in 2000, right at the turn of the century, the U.S. was the major exporter to the vast majority of the world. Now it's China. China is the mass exporter to virtually all of South America, all of Canada, all of Africa, all of Europe. They are the major exporter. So you can't ring fence them off to any great degree, because so many economies now depend on China for goods and services of a variety of things. But we can negotiate a much fairer trading relationship with them than we've had in the past. And that's ultimately going to be the end of this. And so that's why, these tariffs aren't going to lead to inflation, as everybody expects, because they're not going to be there to any great degree. They're going to most of this is going to get resolved over the months ahead. And again, this was, what I said to you, I think last week or the week before when we had the conversation, is that, all this positioning was chaotic up front. But as soon as he realized what the damage was to the stock and the bond market, he started looking for that exit. And that exit was, okay, pause for 90 days, and then we'll go to 10%, but we'll just never revisit the old tariffs again. So it'll just be, we'll move on. The 24-hour news cycle will pass. Nobody's going to remember the Lutnick mistake that occurred back in the original
the big poster board
tariffs
that Trump had with all those crazy numbers
exactly.
on it.
That'll all just fade in the past, and we'll all forget about it. And well, and the narrative, forget about it, and markets will move on, and we'll get back to focusing on what matters in markets, bond markets, stock markets, everything else. We'll get back to focusing on the fundamentals.
And that's kind of where I was going with this, which is, what do you think is more likely at this point? And I think I know from your answer already, but I mean, is it that things are going to become more quieted down, and the bond market, once we make it through the basis trade folks repairing their balance sheets and these deals start getting struck, then we should start to see the 10-year start marching back down again?
Yeah, exactly. Well, see, remember, that was the whole blow up in the bond market, it occurred right with those announcement of tariffs, because again, if I'm a foreign holder of US treasuries and all of a sudden you're going to put these really onerous tariffs on me, I yank all I go, great, I'm going to take my money out of US bonds, I'm going to pull my reserves back. And then that causes interest rates to spike. Well, all of a sudden, it's like the yen carry trade blow up that we had in last year. We had that 10% decline when the yen carry trade blew up. It's basically the same thing. You yank that reserve, you pop interest rates, and all of a sudden that leverage gets called in, and you have this massive kind of wipeout in the bond market. That was all just a function of those tariffs that now will resolve itself. And it's going to take a little time for the bond market to heal up, but it's in that process now.
Okay. And look, folks, again, we're not privy to any inside information. We're just two guys, doing our best to make sense of what's going on here. But the reason why I asked you this, Lance, is a lot of what has, to use a loaded word here, a lot of the uncertainty in the system very well may prove to be transitory, right? And there's a number of people who are, I think, still worried that, this has done permanent damage to the system and to our geopolitical alliances. And we're entering this whole new world where America is going to increasingly kind of become a pariah and all that stuff. And I would just be really cautious of that, because in many ways, international relations are, they're like a marriage, between all these different countries, right? And there are going to be some times where I got to do things one way, but look, we still love each other, right? And even though we shouted and we had a fight, right, we're going to make up. So yeah, even though I pulled out this poster board and said I was going to hit you with all this crazy stuff, behind the scenes, we're going to work out a trade deal where we buy more of the X thing you really want us to, and you bring down your tariffs on us, or you reduce your VAT, or you stop state subsidizing, whatever X, and then we'll make up, right? And so, look, could this thing still blow up? Absolutely. I'm not trying to be total, Trump's handled this super masterfully, but it does seem that we will get more and more clarity, and that this tariff issue will become more and more, as the year goes on, a matter of the past versus a future concern. And that should have a relatively serious or significant quelling effect on the markets.
Well, and look, all of this conversation, set it all aside for just a second. But this goes back to what we started this conversation with, which was be careful of narratives. And this is one thing that you and I talk about almost every week, it seems like, on the show, is that everybody's got a narrative. And you've got to be careful with the narratives, because generally the other guy on the end of the narrative has something to sell you, right? So, I'm selling, Bitcoin or gold or stocks or bonds or whatever it is. I have a narrative, right? And my narrative is I'm managing money for my clients, and my narrative gets shaped by my view on what I'm doing for my clients and how I'm positioning for clients. And so everything that we do in our terms of our research, it shapes our narrative. So we have a narrative, and whether or not you like our narrative or not is irrelevant. It's just our narrative. But you've got to be careful with that, because my narrative can shift, and I will shift my narrative if the facts on the ground change. The problem for most investors are they get into an asset. Let's just pick on gold for a second, because gold had a wonderful week this week, right? Our all weather portfolio is just killing it this year. It's fantastic, but there's a narrative being generated around what's driving the price of gold versus what's really driving the price of gold. And you've got to be able to separate those two out, between the guy that's trying to sell you gold versus why I own gold in a portfolio, and when it is going to come time to take profits and shift those assets into other assets. Because again, that asset will become a source of liquidity when stocks bottom. And there's a long-term historical trend of that in the markets. But when stocks start to rally, it will pull liquidity from gold and back into stocks, because that's where money's been flowing. It's been coming out of stocks as a risk hedge into gold. Mm-hmm. So that's working great. But when that narrative reverses, just be aware that narrative will reverse. And so we've got to change our allocations. And this is why we always talk about risk management, taking profits, rebalancing portfolios. That's an ongoing risk management process that you should be doing all the time. But the biggest mistake that investors repeatedly make is they go, oh, this is great. It's going up. It's now going to go up forever. And you always have to ask yourself this question, right? I remember just a couple of months ago, is like gold's going to go to 3,000 this year. And so gold gets 3,000. Now it's 4,500. If it gets to 4,500, it'll be 6,000. If it gets to 6,000, it'll be 10,000. Right? Everybody always raises their
Absolutely.
estimates. They never say, well, where is it, that this is fairly valued? Well, gold has no fundamentals, so you can't value it. So it's all just price speculation. So that's where you've got to be uber careful with narratives and make sure that when that narrative begins to shift, and it will, that you're aware of that shift. And so, don't get completely indoctrinated into one belief and be unwilling or unable to change that, to change your narrative when the market changes.
So I've said many times, I totally agree with you on that point. So I won't rehash it here. The thing I'll add to it is, look, I own gold. I've owned gold for a long time. I own gold, I'm guessing, for the same reasons that most people watching this video who are gold owners own it. And I will be the first one to tell you, that I have been loving this price action in gold. But I am fully aware that gold could have a pretty substantial pullback here. I mean, it has just moved so far, so fast. Just technically, a fairly substantial pullback would probably be merited. And so, to your point about narratives, whatever your narrative is for an asset, if that asset has moved big, then you should find some way to place a hedge on that correction risk, right? Either, to your point, sell some. Exactly. That's one way to hedge, which is just, hey, I'm going to take some of these gains. Don't have to take all the gains, but let me take some while they're on the table, right? Or you put in, some sort of protective hedge that if that correction happens, you've got some downside protection to it. But to your point, don't just blindingly believe in the narrative and then get caught totally unawares by surprise when that pullback comes, right?
Yeah. I mean, look, a great way to manage the position is just sell some out of the money calls. You get paid a premium today. You may get, and you'll eventually get called away if gold prices keep going up, you'll get called away from some of your gold position. That's okay. You made even more money, right? It doesn't mean you have to sell it, and the big mistake people make is with any everybody falls in love with an asset, whatever it is. I've got a client that worked for NVIDIA, so he's got a huge position in NVIDIA. And when he first came over to us late last year, we said, we got to start selling some of this, right? It's just, NVIDIA is very overbought. It's very extended. It's going to have a big price correction. We've been taking profits in NVIDIA. It was very difficult to get him to let go of that stock because he had built a multi-million-dollar net worth off of working for NVIDIA and collecting that stock while he was working for the company, right? So very hard, that narrative was that it was just going to go up forever because it was NVIDIA, right? So it's with any asset class. And that doesn't mean you have to sell and generally when you try to tell people to sell something, you go, well, I'm not selling it because it's going to go up forever or whatever the reason is. It's never about selling everything. It's just about reducing the risk somewhat. So, if it's 5% of your portfolio, fantastic. It's probably 6 or 7 by now after the run up. Just trim it back to 5. Go back to your original weighting, whatever that was. It doesn't mean that you've lost anything. You realize some of the gains, and then you will. And to Adam's point, a normal price correction for gold should take it back to its mean average right now, which is around $2,300 a share. So when you think about 3,300 to 2,300, the $1,000 clip on gold, you could buy a lot more share. Take your profits, wait for that pullback, and then buy more gold at a cheaper price, right? That's just good management in your portfolio of whatever position, whether it's NVIDIA or whether it's, Apple or Google or gold or Bitcoin or whatever else. I mean, Bitcoin went from 100,000 to 80, right? So now you can buy Bitcoin a whole lot cheaper if you took some profits at 100. Right?
Yep. Okay. And again, this is just some of the, you're just talking about one of the best gardening practices, to use your analogy, Lance, that you use time and time again to protect and grow client wealth at RIA. So, okay, so that's the cautionary note on gold. I'm glad you went there just because I had this on my list here. But Lance, you also tell us too, we got to trade the markets we have versus the markets that we want to have. And right now, gold has been on a massive tear, right?
Absolutely.
So what's interesting is that the mining companies have, for a good long while, they have lagged the price action in gold. Now that's not that's changed recently, and the mining complex is really starting to wake up. But gold is far above its previous price highs, and actually it
Yeah.
just passed a really important milestone where, on an inflation-adjusted basis, using official inflation, so everybody can debate, true inflation rate. But from the government CPI, it is now above its all-time high of 1980, from 1980. So it's the
Yeah.
first time on inflation adjusted. Yeah, go ahead.
Yeah. No, that's such a great point. I pointed that out this week on Twitter, which is it only took you 45 years to get your money back from 1980. So
Yeah.
it's one of the things, one of the narratives around gold is it's a great hedge for inflation. It took 45 years for gold to finally give you an inflation adjusted return. So, and again, this is always the problem about long-term analysis.
Yeah, I mean, I get
It's
the
where
humor,
you
but
pick
yeah,
it's where you pick your entry points, right? And so, this was my point, is that that no matter who it is that's promoting a narrative, right, is that people are really bad about cherry picking data entry points, and they'll pick, well, gold. Do you realize that gold has outperformed the S&P 500 since 2000? So if you bought it in 2000, you've had a bigger return on gold on a total return basis than you have just by owning the S&P 500. Well, that was because the S&P 500 went nowhere for 13 years, right? So gold had a big leg up there over the S&P. However, if I cherry pick a data point like 2011, the S&P 500 has absolutely crushed gold over that time frame, despite this recent run up. So, what's important is that you got to really forget all these narratives, and people haven't owned gold since 1950 or whatever it was, right? You've got to look at things in the term of the time frames that you own it and how you manage that risk over time. And so forget about a lot of that stuff. It is an important milestone, but it completely just deflates the entire premise that gold was ever a hedge for inflation.
okay. So look, I don't want to get wrapped in that
Yeah.
discussion, but it is my point is that there's a lot of
Yeah.
momentum in gold right now. There's a
Yeah.
lot of heat in gold. Um,
Which again, we have the same conversation when there's a lot of momentum in stocks. What's everybody saying?
right. Well, they generally say
Stocks are going to
start lightening
crash,
up. Yeah,
right?
exactly.
Stocks are going
Yeah.
to crash because they're so overvalued, right?
Yeah. So, but here, what I'm trying to do is take the narrative out, right? I'm just
Yeah,
saying
exactly.
gold's raging right now, right? Is today the top? Maybe, who knows, right? But the
Probably
point
not.
is that these plays that tend to act as levered proxies on the gold price haven't performed as such so far. We are now starting to see the mining complex move, but ratios suggest it still has a lot of distance to move before it kind of catches up to gold. And then silver, uh, even more so. Silver really, it's moved a little bit, but very little compared to its historic relationship to gold. And the gold price ratio is now, near an all-time extreme, or at least near historic extremes. So
Mhm.
my point is again, trading the markets we have until we see a breakdown in the price of gold. Like, how long can Wall Street ignore these other plays that, in theory, should really catch up to gold? Are you guys at RA looking at the miners, looking at silver any more closely now? Just because, well, look, if they're tied to this price and the price has really moved, should those things eventually slingshot back up?
Well, they're going to get drug up with the price of gold, but gold miners are absolutely some of the worst allocators of capital
Sure.
historically. Their
So you buy the
fundamentals are
beta.
their fundamentals are terrible. Their management's terrible in a lot of cases. You also have to remember that as gold prices rise, all of the cost inputs into the miners increase. Wages go up, demand of the stuff they have to buy to mine and extract with, those prices go up because now they're trying to extract more gold because of higher prices, which means more demand on all the inputs, which increases the prices, supply and demand. So all the costs go up. So, when you take a look at a lot of the gold miners, they're very overvalued. They're very expensive on a lot of different fronts. And again, just their performance, long-term performance has been terrible. But Their catch up now is simply just psychology. Everybody's now very excited about gold. So to your point, exactly what everybody's doing is like, well, I missed the price of gold, so I'm gonna go buy the gold miners now because hopefully they'll play catch up. And that catch up will probably last for a bit. But again, when you just go back to returning to the base fundamentals of managing money and looking at this, so one of the things that we do in Simplivisor is that we look at relative rotations. And if you take a look at gold miners are as overbought now as they have ever been. And typically they can't sustain this level of overbought conditions for very long. So you're going to see a rotation within the markets out of gold miners back into other asset classes. And then most importantly, if you take this is the risk range analysis that we run on all markets and sectors. But if you take a look at gold miners down here, whoops, I didn't mean to click on that. If you take a look at gold miners, they're currently trading at 30% above their long-term moving averages. That's a very unsustainable deviation from the long-term moving average. And your risk in that sector is extremely high. So again, you may get some more upside here temporarily because there's a lot of excitement right now. You got a lot of people kind of speculating. It's kind of like a GameStop trade, but eventually that move is going to reverse. And unfortunately, when gold miners tend to reverse, it tends to be a fairly big reversion back to the mean. And that distance now between gold miners and their means is very large. So you if you're trying to buy, you really kind of miss the opportunity to buy gold miners. Your risk is more to the downside than there is to the upside momentarily.
All right. So very helpful charts here, and I get your overall points about risk and the fact that it can't sustain where it is. I got to challenge one thing that you said because I know the audience that in the gold stocks probably will too, which is yes, there might be some upward price pressure on the inputs for gold mining, but those things aren't increasing at the rate that gold has increased here. And so the big excitement about gold miners right now, it's not just speculative, it's their profit margins are increasing, right?
Right.
Yeah,
absolutely. Well, that's what you would expect on anything. But again, I'm just saying, don't forget that it's not a zero sum game. It's just my profit margin's 10% at $1,000 an ounce, and it's now 300% at $3,000 an ounce. It's not that, right? Because those inputs go up as the price of gold increases. Yes, you're maintaining a larger profit margin because especially at the rate that gold is rising. I'm just saying, don't forget that there are a fundamental impact to the extraction cost of getting gold out of the ground.
Okay. And look, I know that your firm isn't, you do own gold. You own gold in at least a couple of portfolios, but you're not really a gold mining focused portfolio, unlike some of the other firms that I talk to. So it's fine. But I'm just curious. I was curious if you guys were looking at either the mining complex or silver a little differently these days, given how far gold has risen. Doesn't sound like it in terms of things that you're considering for your portfolio.
Yeah, no, I mean, because we've owned gold for a long time in our models. And so I don't really have a need. I mean, the price of gold is outperforming other stuff at the moment. So I don't really have a need to chase more speculative assets or more speculative risk in the portfolio. It's just not what our models, kind of do. If I was running a gold miner portfolio, which is, had terrible performance for the last 20 years, shoot, yeah, I'd be touting right now that the gold miners are going to the roof because this is my chance to play catch up in performance if I was running a gold mining portfolio. So again, going back to narratives, be careful of the guy promoting a narrative and really focus on the fundamentals. Because again, you get back to these companies, they're really bad allocators of capital, and they have moments of bright spots that tend to leave investors very disappointed over time.
Yeah, and I will say, as a long-suffering gold miner investor, there's an awful lot of truth to what Lance has said there. But the complex is having its moment in the sun, and to a certain extent,
and enjoy it and take advantage of it and enjoy it. But don't forget to take profits along the way.
Well, very much, exactly. And again, just to reiterate, gold is very volatile. Gold miners are, volatility cubed. They're just, and they have been a widowmaker trade for much of the past decade. But they also have generated some lottery tickets too.
They absolutely have.
All right. Last question about gold. I think I already know your answer, but I asked this on X and it generated a fair amount of discussion. Be curious to get your thoughts.
Sure.
So on the day, this was just the other day, gold was up over $100 an ounce. I think it was 2 days ago. And I remember, people in the industry back when I started buying gold, in the early to mid 2000s, predicting, hey, at one point, one day, gold's going to start going up $100 an ounce per day, right?
Yeah.
And we hit that milestone, which was, it was again like you're excited to see it, but you're kind of like worried. So it's like, what is driving this, right? And gold is actually up. When I did that same tweet, I think it was over the previous 8 calendar days, gold was up $400 an ounce, right? So the day gold was up over $100 an ounce, the S&P was down, I don't know, two and a half or whatever. And I put both up in my post and was just like, all right, is anybody else out there who's a longtime gold owner both thrilled by these results, but also concerned that gold might be sending a systemic warning that there's something systemically vulnerable where financial markets are really struggling and gold is racing off to the moon? This gets back into the realm of narrative, which I know you don't like, Lance, but I mean, is there any potential to that? Or, I mean, we just talked earlier about how we think things are probably more likely going to quiet down, but is there any potential that there's something broken or breaking or danger of breaking?
Sure. Sure. No, I mean, look, I mean, like I said, yield spreads are rising a bit. They're not out of control by any stretch of the imagination, but that could change, right? We had this whole bond market scare. That's not resolved. So if yields kind of crack 4.5% on the upside, I mean, there's potential risk there in the credit markets. So, so again, remember the price of gold is driven by speculators. So, that all happens on the price of the NYMEX. So it's just trading, it's futures trading against the price of gold. So and again, this goes back to if I've got to choose where I'm storing reserve currency right now, I've got three choices: stocks, bonds, or gold, because those all trade in dollars. So it would make sense that if I'm having a breakdown in the markets, in the bond market, the stock market, because of what's going on, then my third choice is gold, which is collecting those reserves right now. So, kind of what's happening is what you would expect in a risk-off environment and kind of in the stock market itself. And then there's certainly concerns over tariffs, economic growth, those type of things. Certainly some credit stress in the bond market. So, that's why gold's performing well, and it's going to continue to perform well until those other issues are resolved. And this goes back to Felix Zulauf and kind of what we're writing this weekend is that this, this trade in gold is likely going to last potentially for another couple of months until all this other stuff resolves, and then we'll see a rotation back in the other direction.
Yeah, and look, folks, just being really transparent. Personally, I'm quite bullish on the long-term prospects for gold. I plan to hold my gold for, years, if not decades. Although I do, like Stephanie Pomboy, I do look forward to the day where I sell a good chunk of it to buy other assets at great trade-off valuations, right? The
Well, how are
goal
you
is
going to know
not
when
to.
that's going to be?
Pardon me?
How are you going to know when that's going to be?
Well, I think it's going to be when you and I are talking about how, yeah, I don't know whether it's necessarily a blood on the streets moment or just a time where the economic prospects we think are far outweigh the current valuation multiples. I can tell you it's not
So
going to be.
October.
Pardon me?
So you're talking about October.
I'm talking potentially October. I mean, it could be October, right?
Okay.
If
Well,
gold's
you
at
just said you're going to hold this for decades,
if gold's at
and eventually
5,000,
you'll sell it.
well, some of it I plan to own for like it's just
Sure.
Armageddon insurance, family legacy.
Sure. Yeah.
But the goal is not to die in a coffin made of gold bricks, or not that I have a bunch of gold bricks, but it's an asset, right? It's an asset to be traded at the right time for another asset you want at a much better value.
Right.
Um,
And that's perfect, and absolutely agree with that.
Great. And so I am, like I said, that optimistic about gold. That long term, I'm going to hold on to it with those tight hands for the most part. But I do think right now there's a bit of a Purell factor, that we got to be careful in here, which is, we all remember everybody rushing to Costco and the fist fights over the toilet paper and the Purell and the N95 masks, right? They were scarce. Everybody was worried. That gave a tremendous premium to these items. And then once the pandemic ended, you can hardly give away the Purell, right? And that's not a great analogy because I think gold's always going to have a fair amount of demand out there in the market, but there is undoubtedly, I think, some uncertainty premium that gold has right now
Absolutely.
because of the tariffs, because of the basis trade, because of some of these things that we're talking about. And as those get resolved, presumably that premium is going to then bleed off the price of gold. How much is that premium? I don't know. Is it 5%? Is it 20%? I don't know, but I'm mentally prepared for that. And I'm just saying, if you're, a gold holder who's cheering this, great, enjoy the time, enjoy the ride, but be mentally prepared for that potential cooling off.
Right. Well, and just remember that uh, mean reversion events, when they occur, are always larger than the actual premium. So say your premium, you're overpaying your premium right now by 30%. Mean reversions events can be 40 to 50 when they occur. So it's always past the premium. So again, this is why it's really important to kind of just pay attention to long-term deviations from means. Look at a monthly chart of gold versus its long-term moving average, and that'll give you a really good example of kind of historical precedents for reversions and consolidations. And again, you kind of go back and look at history, going back to 1950, gold has reversions of 50 to 70% and long periods where it just goes nowhere. And again, there's nothing wrong with that. It's just that the money's moving into other assets. And then eventually gold goes through its spike again, like in 2008, when you have a risk off event, or like now you have this risk off event in the markets and gold's doing exceptionally well. So it's a great risk off hedge. And it's actually doing its job very well this year, of doing that work in the market.
Yeah, and look, one thing I want to note too, because like I said, it wouldn't surprise me to see a material pullback in the price of gold, and I'm mentally prepared for that. But I don't think it necessarily has to. I mean, gold, to your point, it just could go sideways for a long time at some point. And one of the big differences between now and the previous inflation-adjusted spike back in the 80s was that, in 1980, the Western retail buyer was panic buying gold. And I've got stories from coin dealers who were operating shops back then where they had lines around the block. They'd have to literally to be able to transact, they'd have to let the buyers in first to have product to then sell to the, or sorry, let the sellers in first to then have product to buy to the buyers in line, because inventory was so tight. So right now we do not really have much demand amongst Western retail. It's still primarily central banks and Asian investors. So this isn't quite like a mania like we had before. So I wouldn't expect as much of a correction. Again, that's just one guy's opinion. But anyways. All right. Well, look, moving on from gold. Actually, last thing, folks, just on gold, if you haven't yet read Thoughtful Money's free guide to how to buy and store gold and silver, but are thinking of potentially either getting into precious metals now or increasing your exposure to it, just go to thoughtfulmoney.com/gold and you can read that guide for free. All right, Lance. Question I meant to ask you earlier when we were talking about stocks. You talked about how the sell signal is still on. You talked about how now that we've risen a little bit since then, you wouldn't expect to see the market. You wouldn't be surprised to see the market come down a bit. When that sell signal happened, you decreased your portfolio's equity exposure by 25%, right? You've got those 25% milestones, right? What will you be looking for to add that back in?
Well, so again, we actually added exposure before we decreased exposure. So again, I was talking about on the Wednesday, we didn't know that President Trump was going to announce this pause of tariffs, but Wednesday morning the market was selling off. Remember, we had multiple days where the market was just down 2,000 points in the Dow, 1,500 points in the Dow, very reminiscent of what we saw during the 2020 pandemic. Well, that Wednesday morning, the markets were opening down, but tech stocks were holding up. They were actually turning positive. And so we were seeing money flows come in. So we went in and we bought positions in NVIDIA, Microsoft, Google, Palantir, and Palo Alto Networks. And then that afternoon, President Trump announces it. Those stocks go surging. Apple's up 20% for the day. Microsoft's up 20% today. NVIDIA's up almost 30. The next morning, we took those positions back off again and reduced. That was when we reduced, equity by 25% and added a short position to the portfolio. So where it's pretty much where we're going to hang out here. Now, we are okay adding positions. Like for instance, on Tuesday, we bought ExxonMobil and Diamondback Energy. The reason is oil prices were so extremely beaten up, you're going to get a reflex rally in energy stocks, and those stocks have performed very well this week, despite the market being off. Yesterday, energy stocks were up, 3.5% to 7%, depending on the stock that you own. So energy stocks are also now, I can add positions in the portfolio to things that are really beaten up. Eli Lilly is a good example. It was up 15% yesterday on their announcement. I can add stuff to the portfolio that can also act as a hedge by going up when other stuff is going down. So, we're working through the portfolio. That's why it's so important where we go back. And again, it's very easy. And look, I can already hear the screams of people in your comments over our gold conversation. And again, I'm not a gold bug. I'm the first one to admit that because I don't care about gold. I own gold personally. I've got some gold coins that I keep in a safe. But as far as an investor goes, I just care about the price. I'm not tied up into a narrative. I don't care about the end of the world or any of that nonsense because it very rarely matters. What I'm more concerned with is, can I make money with an asset? So that's why we look so hard at things like relative rotation within the markets. And so when we start going back and looking at relative rotation models, and particularly looking at things like the individual sectors of the market, technology is some of the most oversold sectors of the market. Transportation, I wouldn't touch transportation, even though it's really oversold. It's oversold for a reason, because most of the companies in this is regional airlines, and they're absolutely getting fundamentally pummeled. So sometimes things are oversold for a reason. So you got to sort through that. Consumer discretionary energy. Energy was way more oversold before the rally this week. It was actually 2 weeks ago. It was like one of the most oversold sectors, which was why we started buying into it. So now where I'm looking to take profits out of are things like utilities, staples, industrials, which we did reduce those because we'll get a rotation back in the other direction. So these will eventually get sold off, and then we'll start to see these other sectors like technology starting to perform a lot better. And again, this kind of goes back into the other analysis as well. Again, gold miners are more historically overbought and deviated than just about any other point in history. This is going to be a losing trade probably sooner than later. If you're trying to buy it here, if you own it, great. I would take profits. Nothing wrong with that. But if you're trying to buy it here, you're probably buying at the wrong end of the stick. I'd be looking at things like high beta, high quality factors, mid cap, small cap, which has been really beaten up. If we get relaxation on tariffs, if we get to see, and particularly as we move through earnings season, we're about to start getting corporate share buybacks coming back next week. So when that window opens back up, high beta names should start performing a lot better. So I would look for a rotation back into those sectors and those stocks as well. But again, this is why rotation is so important, because the market just rolls through this. Markets don't care about narrative ultimately. What it looks for is, where do I reduce risk? Where do I buy risk? Where's my best opportunity? If things are really overbought, as a trader, I'm going to take money out of those sectors. I'm going to buy stuff that's really beaten up, because that's where I can make the most money. I can't make money in stuff that's already overbought. There's nothing left there to get. There's a lot of opportunities in companies that are really beaten up. Let me give you an example. Adam, you're a reasonably smart guy. You went to Stanford. If I told you that I have a company right now that trades at a one-time PEG ratio with a 91% growth rate in earnings over the last 5 years, would you be a buyer of it?
I'd certainly be interested in becoming one. Yeah.
Yeah, that's NVIDIA, by the way.
Okay.
So again, this is the point. We've got to get past narratives and start looking at fundamental factors and rotations. That's why this is so important in terms of money management. Is that it's about managing risk. It's never a sell everything. It's never a buy everything. It's never be in one asset everything. It's about managing risk in portfolios. But that's where we are in this market cycle right now, is that things have gotten really out of kilter on both sides of the scale. And again, back to Felix Zulauf, he's absolutely right. We've got such negative sentiment and such negative pessimism that when that turns, there's going to be a massive rush back into particular areas of the market. There's going to be a lot of money to be made later this year.
All right. And for you as an active investor, does that, Is that a welcome smell of opportunity to you?
Oh yeah.
That, hey,
Yeah,
there are
no,
inefficiencies and I can take advantage of those?
yeah, absolutely. That's why we're building a shopping list right now. But we see, we still own the stocks that we like. And again, like we reduced Eli Lilly from 3% of the portfolio to 1.5%, but we're still holding it because fundamentally it's a great company and they're going to continue to grow. And with this development of the pill version of the GLP-1, this is going to have a massive boost in their sales. So again, you got to, again, headlines are one thing, and looking at the global market and say, oh, the markets are doing terrible. The markets may not be doing great, but there's some individual companies that are doing exceptionally well if you pay attention to what's going on underneath the surface.
Okay, Lance. Well, let me just connect one thing here. So you've got a shopping list. You're seeing some companies that are doing great, but how do you balance that versus we might be heading into recession, right? You wrote a piece recently that inflation looks like it's not going to be a big problem as we go further into the year. You mentioned that you're seeing increasing signs of global economic slowdown. We're seeing weakness in the luxury buyer. I shared some results about LVMH last week. Hermes just came out with bad guidance again this week as well. Goldman Sachs has said luxury is in late cycle, right? So sort of a warning that, hey, this is sort of what we see before there's a downturn in spending. And of course, the affluent consumer has been propping up retail sales. So how do you balance this? Like, hey, we're seeing, some good signs of life here, and prices are getting a bit cheaper, but we might be heading into recession, and maybe that could continue to pull prices down as companies have to tighten their belt and fire workers and stuff like that. How are you balancing the two?
Well, so two things. One is that first of all, let's just be clear, there's no guarantee of recession.
Absolutely.
I'm more in the corner of a pretty significant economic slowdown. So, again, you kind of go back and look at last year's growth rates. We were at, 2.5 to, 2.8%. We're at pretty weak growth in the first quarter, probably by the time they announce it, probably be 1.5%. So if we get down towards that, again, we still have to go to get to a recession. We've got to reverse whatever economic growth there is to get below zero, right? So there's still a good bit of economic slowdown before we even get to a recession. And so and this is why over the next several months, that markets could be somewhat challenged. And we'll see kind of this consolidation in the market as markets begin to reprice for slower than expected earnings. We start to drop forward estimates down. Valuations have come down fairly sharply here in recent weeks. So as we start to realign valuations with forward earnings as the economy is slowing, then markets can say, okay, I'm kind of where we are, and I kind of see what this will be. And I'm coming out of this, we're going to have some pent-up demand. And then that's where stocks are going to start pricing for forward expectations of a reversal back to growth. And that's kind of Felix's point. Now, if the slowdown takes longer to drag through, let's say it's a really slow grind towards slower economic growth, potentially even a minor a minor recession, that, maybe this bottom in the market doesn't occur in October, maybe it's January of next year, right? Timing is always difficult, but it's going to be this process that markets always kind of front run the recession. So if you're expecting a recession, markets already pricing that in right now. The recession may show up or be announced by the National Bureau of Economic Research, a year from now. But by the time they announce it, we'll already be through the recession and markets are recovering. So again, that's why the real risk for investors is sitting going, oh, I think there's a lot more downside to stocks. You got to be real careful with that because markets are already pricing all that in. That's what's happening right now. That's the sharp drop off in the markets is pricing in the impact of tariffs, slower economic growth, potential recession, higher interest rates, all that. That's what's happening in the markets right now. And the markets are going to get through this period, and then they're going to start looking for opportunity while you're in the back seat going, I still think there's a recession coming. Prices are going lower. Markets are way ahead of you. They're 3 cars ahead of you down the freeway, right?
Yeah. So is it fair to say that I mean, you're in the game. It's not like you've liquidated your portfolio by any stretch, but
Right.
it sounds like you're saying, hey, as we get further into the year, I'd rather be a little early in these assets than late, right?
Yeah. Well, look, there's nothing wrong with being a little late, right? There's, you know,
No, but there
people
is
always
being too
try to,
late, which you always say, which is if they
well, yeah,
move and then you're chasing. Yeah.
yeah. If you're 5 years too late, that's a different story. You know, there's nothing wrong with being a little bit early. There's nothing wrong with being a little bit late. And, the problem is people are trying to always time the perfect bottom, right?
Right.
And so when the bottom hits and the market starts to recover, then what investors do? So I'm all out. Just get me out of stocks. And then the market bottoms, begins to recover, and then they go, well, okay, it's recovering. So as soon as it pulls back, I'll get back in. Then the market keeps going, right? Well, as soon as it pulls back to where it was, I'll get back in. And then they never get back in, right? It's a constant, chase of the market. And now it's going to crash again. So I can't get in until it crashes again. And so they just don't get back in the markets. So, from an investment standpoint, and this is, again, kind of going back, to just managing money, forget all these narratives, forget all the conversations, just focus on the price and, look at what you're trying to achieve. And if I have a good company in my portfolio, I want to own it. And because, and here's the big narrative. I'm writing an article on this for Monday about the death cross, right? It's like the 50 cross below the 200. It's a death cross. That sounds very, very bad. Sounds like a horrible thing. The vast majority of the time, death crosses last 3 to 4 months unless you're inside of a recession, and a pretty big recession. And then they tend to be longer. But on average, go back to 1950, if you
Right. And
buy
sorry,
the
let's
market,
just tell folks what a death cross is.
oh, okay, it's when the 50-day moving average. I'm sorry, I apologize for that. It's when the 50-day moving average crosses below the 200-day moving average. So that's considered the death cross. Now, what doesn't get a lot of publicity in the media is the golden cross, which is when the 50 crosses back above the 200. That's your bicycle, right? But these crosses tend to, on average, tend to be fairly short-lived, and by the time they occur, markets are often very near their lows. So if you go back in history, if you buy the death cross in your portfolio, you may suffer some short-term downturn in the markets, with this exception that the markets go into an event-driven recession, a structural recession, like the dot-com crisis where you had major companies failing, Enron, WorldCom, the financial crisis, 2008, you blew up the whole financial sector. Outside of structural bear markets, those crossovers tend to be fairly short-lived. If you bought them and within a year, you've been on average up 15% in your portfolio. So again, this is why you got to be careful with narratives, be careful with the headlines. You're going to see a lot of negative headlines about the death cross in the markets. Be real careful with that because again, unless we're going to enter into a structural bear market in terms of we're going to have another financial crisis related event in the economy, this correctional process that we're working through right now will likely be over by the end of the year. And then markets are going to start pricing for better outlooks going forward.
Okay. All right. Well, folks, you may be detecting a little bit more of an optimistic view than you've heard in recent months on this channel. We'll see what happens from here. We'll keep updating you on this weekly going forward. Maybe this is a little ember that we nurture and and grow as the year goes on. And look, for a guy who oftentimes gets painted, as you do too sometimes, Lance, as an uber bear. Really what we're just looking for is great opportunities to make money for the folks that watch this channel. And I would love nothing more for that to present itself as the case as we get further into this year. So folks, we'll keep tracking this on a weekly basis going forward from here. We'll get to your trades in just a second. One little bit of clarification I want to add too is, you were pushing me, Lance, to say, well, hey, you're going to sell your gold as soon as this fall, right? And maybe I will sell some, but I do just want to provide a caveat for well, I probably likely won't because I have a long-term vision for the gold. I have
and what is that?
I have a lot of cash and cash equivalents right now.
Right. So what is your long-term vision for gold? I'd love to hear this.
We'll get into that more later. We don't have enough time because I'm trying to wrap up. But my point is,
and that's, look, dude, that's completely fine. I don't have any outlook for any asset like that. I don't have narrative for any asset.
Yep.
So that's just not my vision. So my point is that I know people are in your chat or get all upset because maybe I offended them in their narrative. I don't have a narrative. I don't care about gold. I don't care about Bitcoin. I don't care about stocks. I don't care about bonds.
Just to be clear, that's why I have you on this channel, Lance.
I just care about making money. I just want to make money. That's all I want to do.
Yep, you are the Vulcan voice of reason and data on, I just want to make the next best investment. For me, there's a big part.
Don't be offended if I offended you and your narrative and you're watching this channel. I humbly apologize. It is not my intention. I just don't have a narrative and I don't care. I'm not trying to sell you anything. So
Yeah. And folks,
yeah,
go easy on Lance. But the shorthand for, you know, why I have this long-term view is I feel of all the predictions that I can make based upon having been in this business for, you know, decade and a half, is that the purchasing power of fiat currency is going to continue to diminish going forward. And gold is, I see as part of just sort of a foundational defense against that. It is not by any stretch my entire portfolio. The point I wanted to make is I have a lot of defensively positioned capital in cash and cash equivalents, and that is the first thing I'll deploy, Lance, when we start seeing those good valuations. All right, so let's get to your trades, and I have a quick rant I want to slip in before we end.
Yeah, so I kind of mentioned this earlier that this week we bought energy stocks. We bought ExxonMobil and Diamondback Energy. Two reasons: one, the dividend yields were very attractive, but two, they were so extremely beaten up. And again, this is where you start looking at assets. So, and again, just going back to gold for a second, or Bitcoin, or stocks, when things are trading at 3 times their deviations or 3 standard deviations above their long-term means, that's a great opportunity to sell assets. If they're trading at 3 standard deviations below their long-term means, like energy stocks, that's a great time to buy assets.
Great time to buy. Yep.
Right. And so we bought energy stocks because the recent sell-off in that sector has been absolutely brutal. And those companies print money, particularly even in this environment.
Right.
Fundamentals
And dividends
are strong,
too, right?
dividend yields are strong.
Yep.
And if you get any type of, you know, and again, this is just a trade. We'll sell it. We're not buying energy stocks and holding them for the next 20 years. This is a trade, and we'll likely trade this position. We're up nicely in the position in the last 3 days. We may hold it till next week, maybe the week after that, but we'll take those profits back in and raise cash for the portfolio again.
Okay. So those trades were basically the 2 main trades you made this week?
Yeah, that's all we did this week.
Okay.
Yeah.
All right. Okay, getting to the rant real quick. So Lance, you and I talk a lot about health, one of the true forms of wealth, and the main pillars of like physical health that you know, I think the research is relatively clear on. It's functional fitness, it's nutrition, it's stress management. I would add mobility in there, and then sleep hygiene, right? And if you're just looking to feel better in your body, right, those are kind of like the 5 key things to focus on. And we've talked a lot about the functional fitness part. We've talked a lot about nutrition. Nutrition probably is the most important. They're all important, but it's probably the most important one of the 5. But one I think that gets really short shrift, especially in Western culture, is sleep hygiene. Most people have terrible sleep hygiene. And reason why I'm bringing it up this week is I actively try to work on all those 5 things. I probably should work on mobility more than I do, but I do try to work on that too. But the one where I've really struggled has been sleep. And I've really tried to get it right. But I will say for the past, couple of years, I have just not been able to remember the last night where I woke up in the morning and felt anywhere refreshed. And most times I've woken up and felt like I could go right back to bed for another 8 hours. And I kind of had this superpower, which I developed, I think, from initially working on Wall Street, where I worked just, literally 100+ hour weeks. But especially the past couple of years, like if I've got a free 5 minutes, man, I could go out like a light on command if I wanted to, right? So there's just always been this chronic exhaustion, and it hasn't kept me from living my life. Certainly been working a really aggressive schedule running this business, but it's been this persistent thing I just couldn't shake. And there's lots of things you can do. You can create a good sleeping environment where it's dark and it's cool, and you've got a good mattress and good pillows, and you don't look at your devices, an hour or 2 before you go to bed. I violate that a lot, but still, when I try that. Don't eat before bed, lose weight. There's all sorts of things that you can do. And I just got to say, a lot of them weren't working. And I was really trying to work on increasing my hours in bed, and that really wasn't making a big difference. And the reason why I'm giving all this is I finally went and got tested. I had a sleep test, which is really easy to do now. They just give you a little thing that goes on your finger at night, and you sleep on it for a night or two, and you bring it back. And anyways, I was diagnosed with mild sleep apnea, which I think lots of people have. Um, and I was happy to get the results that, okay, there's something here I can work on. Now, I got to tell you, the main way to address sleep apnea, you can't cure it apparently, but the main way to treat it are these CPAP machines, right? It's like sleeping with a snorkel on. And I really resisted the thought of ever having to be dependent on a machine for sleep. But I said, eventually I was like, you know what? Let me just try it. So I'm currently in a 1 week sleep trial where they give you one of these machines to take home. And I got to tell you, it's super awkward. It really feels totally demeaning. It's like the dog when you put the collar on the dog, like the cone on the dog, right? He just sits there in shame, right? It just feels awkward. That's what I feel like with this thing getting into bed. And it's early days, but I got to tell you, Lance, after the first night, I really felt different in the morning. I've now done it for 3 nights, and it actually really does feel like it is making a difference. And apparently, the difference builds at least initially in the first couple of weeks, months that you do it. So um, I don't know if it's something I'm going to embrace fully going forward, but it feels very much like a plant that it was like bone dry, right? And just on death's door because it hadn't been watered in months, getting a little bit of water and feeling that life start to go back into it. So I don't know what your sleep situation's like, but I bring it up because sleep is like I said, it's one of the great things that's ignored by our culture. The research is super clear that most people have terrible habits that are impacting, their performance in the world. And just personally, I feel like I'm beginning to get more that energy back that I just felt I'd been missing for a long time. And mental acuity. I just feel like my brain has more RAM in it. As a result, maybe it's psychosomatic. Again, it's early days, but it's just reminding me how super important quality sleep is. And I want to put in a big vote for that. And if you're somebody who's struggling and maybe have some of the symptoms that I mentioned of just sort of fatigue and tired, be able to fall asleep on command and just not having that energy, maybe go get one of those sleep tests. It's covered by your health plan, very cheap, and at least see if you've got an issue going on because it is treatable.
Yeah. No, I sleep like a rock. So I can lay down, go right to sleep anytime. I can sleep standing up.
Yeah.
So
Well, I'm curious, is it quality sleep? Do you wake up refreshed?
yeah, yeah. No,
Oh, so
I
you're
have a
good.
real
Okay.
set, I have a super set schedule. Again, my whole day is very structured. And the thing I don't want is people to mess with my structure because I have a specific time where I write, specific time where I work, and I eat at a specific time. I have a certain diet that I follow. I go to bed at a certain time. I wake up at 3:30 in the morning, go to work, those type of things. So as long as I keep my schedule, I'm good. If something gets me off that schedule, then I'm cranky.
Yeah. So I'm totally like you. And again, I was really leaning into the routine to try to just see if I could get that sleep thing fixed, and I couldn't. So which is why I bring
Yeah.
up this whole story, which is just I found this as a piece to the puzzle that clearly is helping with what was missing. And so again, if somebody's listening and just saying, "Hey, I've been looking at my life and I can't figure out what's causing this issue," maybe this is something to look into. All right. Well, with that said, Lance, as always, you're doing yeoman's work here, keeping our eyes on the prize and trying to keep us safe from all these narratives that can be influencing our thinking, folks. If you think one of the best ways to protect yourself and your money from being unduly influenced by dangerous outside narratives is to continue watching Lance Roberts on this channel week after week, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Folks, if you haven't yet watched the interview with Felix Zulauf, make sure you make that part of your required viewing this weekend. It's actually a shorter interview than normal, so you can bang it out pretty quickly. But like I said, it's a very important one to watch. And if you'd like some help in navigating the road ahead, both this potentially bumpy, volatile road over the next 6 months or so that both Felix and Lance think may lie ahead of us here, but also then position yourself smartly for what might be better days after that. I highly recommend that most people watching this benefit from the help and guidance of a good professional financial advisor. If you've got a good one, great, keep working with one. But if you don't, feel free to request a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me week after week on this channel. So if you'd like to request a consultation with one of them, perhaps even Lance himself and the team there at RAA, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds. These consultations are totally free, and the firms will be reaching right out to you after you fill out the form. Lance, my friend, it's been a great week. I'm glad you're getting quality sleep, my friend. Hopefully I'll catch up to you soon. Look forward to seeing you next week.
You got it. See ya.
All right, everybody else, thanks so much for watching.